so-called irrelevance theorem. Right? So yeah, it's pretty weird, and researchers are pretty straightforward about it. Nevertheless, they got the Nobel Prize, and the paper they wrote is one of the most cited papers in finance, and discuss maybe a little bit why that is the case. But then, to make it more realistic, we have to deviate from these perfect markets. So that's really what you do in the next semester's class with Ursula Walter, and going through all the different imperfections, like how about principal-agent problems? How about asymmetric information? How about incorporating taxation in the picture, right? How does that change the capital structure decisions? Right, so I'm really consciously ignoring this part here because you do so much on this in next semester's class, and I don't want to have any overlaps. And then there's a third element of financial decisions of a company. It's a little bit difficult to kind of put in this picture, but there are the risk management decisions. So risk management can be done by kind of changing the balance sheets through adding new financial products, right? So the products can appear here and here, right? Depending on whether you have whether you buy it or whether you sell it, right? So let's put numbers next to them, and the third area here would be risk management. Again, the word risk here is really important for our class. I think I have this on the next slide. Yeah, so but maybe I'll mention it here briefly. So for risk management, of course, there are several things that you have to know. So first of all, you have to know what your risk is, right? So you have to measure it. Think about what are good measures and bad measures. The second is you have to be aware of what products are available. How can I use them to manage my risks? And the final part would probably then you have to report this to your shareholders, for example. You're actually by law mandated to write a risk report that auditors have a look at it every year. So that's kind of the first big group of decisions on the corporate side. And many questions run down to the point is what's the value of a project, what's the value of debt and equity, what are the conditions that I have for a certain product, and that will be the key focus of what we do in the class. Then on the right hand side we have another big group of people, which are the investors. So how did they come into the picture? So basically, if you look at basically where firms are interacting with the capital market, then it's usually through their right-hand side, right? So through the financing decisions, they are in need of capital. So in the capital market, the corporations are the demand, basically. But where does the capital come from? Well, it comes from investors. So investors are the supply, right? So very key economic principle, when you want to know something about markets, you have to study supply and demand, right? And where they come together, you have that, what we call an equilibrium, and that's key building block of kind of a financial theory. So, nevertheless, there is some similarity because actually you can split up the decisions of investors also on basically these two areas. So, the left-hand side of the investor balance sheet would be kind of what do you do with your money, and how do you invest it, what's the strategy? And in this class we will call this portfolio choice, right? So investors would create portfolios. So how do they ultimately do that? And that will tell us something about the supply of capital. And the second thing is they can also borrow themselves, right? So they can make leverage. So basically it's mirrored again, so you have the investment decisions. So that's what we call portfolio choice. And then you have the borrowing decisions. Again, the valuation part is really important. because, for example, if you want to kind of borrow money through interest rate products, you have to know how to compute the value of that, and so on. So, as the name of the class suggests, the word financial instruments is in there. So, the key thing that I would like to do here with you is to go through the main products which are available, not only to corporations, but also to you personally as investors. Right? So, for example, the chapter on stock options that we're going to look at is something that's not so relevant for corporations, it's rather relevant for investors. So if you want to have your private trading strategy based on options, then that will be something that you could learn from this class. And in Germany, there is a very big market for these derivative products for retail investors. If you're interested in that, we can have a little bit of a deeper look in this. So now, how do these two groups of investors interact? Well, it's in the capital market. The capital market is kind of what's kind of moving these two groups together. So most importantly, we have the interaction here between the financing decision and the capital market. So this is the demand for capital. And then we have the biggest interaction here with the investment decisions of the investors, that's the supply of capital. So I like to view for demand and supply like this, but I just realized that there's some theories which actually flip this and say that the supply is the securities provided by the corporations and the demand is that what the investors would like to buy. So you could put it the reverse if you want. But I think this direction makes more sense, right? So the capital is passed on from the investors to the market, then onto the corporations. So what are the big things that come out of the markets and that we need to study here in this class? So the first thing is we have to be aware of what are the products which are traded here. And then the second thing is the valuation part, valuation or pricing. So my aim here for this class would be to have a very good overview of the most important financial products that you can at least, that you understand how they work, basically how the cash flows are from a product, and that you can apply basic valuation principles to compute the price of a simple product, that you basically understand how this works. Any questions so far? So let me motivate a little bit more than what the importance of the capital market is. So what are the roles that the capital market fulfills? That's why it's so important to study it. So first of all, it gives us information about prices. Right? If you're interested in, for example, a certain company, you can immediately learn about many things by just looking at the share price. Right? Or you can sometimes find information about what the rates are that a company can borrow at, which is the so-called credit spread. Right? It tells you of how much the credit spread is, like the interest rate that the company has to pay. On top of that, what the government would have to pay will be considered risk-free. Right? So both things, the share price and the credit spread, incorporate information about like the future perspectives of the firm, but also about the risk. Right? So that's all part of the prices that we observe on a daily basis.